Hey, Bulls and Bears, we are back with another dose of economic reality. My name is JJ. You're watching Bull, Boom, Bear Busted. It's Wednesday. What's the date today? February 8th, 2023. And we have quite a bit of news to get caught up on today. Now, as I'm reporting this, the Dow Jones is down by about 100 points. But it's definitely been an interesting watch on the stock market over the past few weeks, especially. We've seen days where markets were in the red by 200, 300, 350 points. Then miraculously, before the end of the day, we have a bunch of mystery buyers that come in and push the market back up. And I know that on this channel, I have more than a few viewers that are also day traders. So good luck day trading these markets. But with the current state of the U.S. consumer, the average person, not the top 10%, but the bottom 90% or the middle class, with the average state of the average person's savings, it's pretty easy to see who's actually buying these dips and who's pushing the stock market back up, at the end of the day, especially. And I think most of you know by now, because I've reported this many times, that the top 10% own about 80% of all stocks, or rather, the top 10% own about 90% of all stocks. And that also counts institutional ownership. For example, you have Warren Buffett, and then you have Berkshire Hathaway that owns a whole portfolio full of investments. So both individual ownership and institutional ownership, that's very heavily concentrated towards the top 10%, 90% of all stocks, folks. All right, and I know I've said that before, but I have to keep on coming back to it. One, we have new viewers. And two, I think it's very important not to forget that when you're thinking about jumping into these markets, who really controls these markets, right? You have big money that they all get together at the same time. Two or three big institutions get together and decide to sell. That's going to actually move the markets, and it's going to push the little guy right out of the market. So if you go in with your buy order and an institution sees that, they can push the stock back down just so you're underwater on your trade that you just bought. Let's say you just bought a stock. Now, if you wait it out, of course, you may come back to even or maybe even make new gains. But in this current economy, we have to ask ourselves, how much further the top 10% are going to push this stock market up, because it gets to a point where they're just buying and selling amongst each other, right? So one institution sells, another institution buys, and ask yourself how long that's going to last. Now, I called the top at the end of 2021 going into 2022. We still haven't hit that high yet. We still haven't breached that all-time high. We're still well below that. Let's take a quick look. Then we've got some other news to get into as far as personal finance and the broader economy. And we'll just go into a 5-year chart here. This is the Dow Jones. We see a peak in late 2021 there in December, and it was about 36,338 that day. We're just over 34,000 right now. And again, I'll be very surprised if we breach that all-time high. And actually, I'm betting against it. I'm shorting the market here, going short on an ETF, basically. So an ETF that tracks the broader market. What I'm doing right now is putting put options against those, because I don't see us going much higher than this low 34,000 range. Again, I could be wrong, but I'll let you know how that trade goes. I think a big part of the market strength that we've seen now just over the past few months, and why it hasn't dropped further, is because of one, massive stock buybacks, and two, massive short squeezes, where a bunch of institutions get together and they try to get a bunch of retail investors to basically wipe them out because they're short, and the big money can just come in and push the markets up until those shorts are no longer solvent, or until those put options expire. So it's a big game of they're trying to take your money. That's what it is, manipulation. Now, one thing that I am a fan of is holding certain stocks that pay out pretty good dividends. For example, right now I've got stocks that pay out 4.5%, 5% dividends, and that's the equivalent of what you could get if you put it into an online savings account. Now, if the stock market goes down, that's not going to be the best bet in the world. A lot of people are now moving their money, their savings, into some online investment accounts, for example, not investments accounts, but savings account. For example, Capital One, you've got an online savings account. And the last time I checked, they were yielding close to 4%. And, that's not bad. It's still not going to keep up with inflation, but it may be a safer bet than trying to go into the stock market, where you're going to get maybe a 3 or 4% yield if you're lucky. But then you have the risk of that big downside if all the big money decides to sell. Now, one of the big struggles for small-time investors now, small-time meaning not a big institution or a hedge fund, or a billionaire, but just a middle class person. The average retail investor is what we call them. One of the big struggles is having money to even invest because the cost of living is so high. People racking up debt like never before. On that note, let's go ahead and take a look at a few articles here that further prove to us that this economy is going down quickly because the U.S. consumer is doing very, very poorly here. Let's take a look here. Another big surge in credit card debt right here out of CNBC. Americans lean more on credit cards as expenses stay high. 46% of cardholders now carry debt from month to month. This is what we warned about going all the way back to the end of last summer when we started seeing these big surges in credit card debt. More people not paying off their card in full each month. Credit card interest rates close to 20%, folks. This can't last much longer. I don't see us getting out of 2023 without a major, major bankruptcy storm and financial crisis 2.0 here. And by the looks of it, by the end of the year, it's going to be most people. That number is going to reach 50% plus by the end of next year of people not paying off their card in full each month, meaning carrying balances from month to month. And at a 20% interest rate, that doesn't last too long before you see a lot of bankruptcies. Now, we're yet to see the big increase in bankruptcies. Yes, bankruptcies are up compared to last year, and last year was up compared to 2020 or 2021 rather. But it's really going to surge this year. That's my prediction, unless they come out with some sort of intervention, a massive rescue program like we've never seen before. Which is a possibility, but we're going to keep an eye on that for you here. And another one here out of Fox 10 here. Americans' personal debt tops $16 trillion. Average debt load reaches $165,000 per household. And if you go down here, credit card debt grew 28% last year alone. 28%. So if it was 28% last year, what's it going to be this year with the higher credit card rates and more people not paying off their card in full each month? The debt is just going to explode this year, 2023. Now, some people say, and I see some of you down in the comments, you say that, well, it's okay because the cost of living is going to come down. The Fed, they're winning the fight against inflation. They're raising rates and they're controlling prices. Prices are coming down. Prices are coming down in a few spots, but the Fed's not even trying to lower prices. What they're trying to do is get back to the 2% inflation target. That means prices are still going to rise just more slowly than they were previously. So they're not trying to lower the cost of living. They're not trying to lower inflation overall. Yes, in some areas you're going to see lower costs, lower rents here. We'll have to see what happens this summer. But so far this winter, the rent decline was the biggest decline that we've seen over the past 5 previous years. When we look at the 5 previous winters, winter typically being the time when rents actually drop. And then we see rents typically go up in the summer. We'll have to see what happens this summer because that's the hottest time for people moving and relocating is in the summertime, the spring and the summer. And more people on fixed incomes are really having a tough time. At my job, I talk to people all day about finances, and I'm seeing more people, especially older people, retired people, really, really struggling. And something that I noticed here just in the past few months, just going around to different stores, I'm seeing more older people in the stores, working at the stores, at the cash registers. One of the Dollar Trees in my area, lady working there must have been in her 80s. And, God bless her. She's working, but you can just tell that she doesn't want to be there. She's not there for a social outlet, I don't think. Another store also, somebody that's probably mid to late 70s, grocery store, someone working there. And I couldn't imagine that these people don't want to be somewhere else besides in a store where you might have somebody come in and, who knows, rob you. Just working in retail in general can be kind of stressful. Can be kind of a bummer. Just the customers that complain. I remember working in a store when I was like 19 years old. Department store back in Michigan called Meyer. It was fun, hanging out with the coworkers and stuff, and just having a job was fun back then, But a lot of complaining customers, and now it's even worse than what it was back then. But I really have to give it up to the fast food workers. Those people put up with a lot of snotty customers and A lot of problems. The shake machine's broke. Then the customer goes crazy and starts throwing things around. Have you guys seen those videos? Another recent article here, CNBC, and we know this is happening, but I want to give you an update on it. Auto loan delinquencies are rising. It's up about 27% now, higher than what it was last year. And these are people that are 60 days plus late on their car loan payment. All right, so about half the credit card holders now, people holding credit card debt, are not paying it off in full. Surging late payments here, rising to over 20% year over year. Surging debt. So yeah, this year is going to be the year, folks. I don't see it happening any other way. And it's a slow motion collapse, right? You're not going to wake up tomorrow and it's going to be Armageddon on the streets, unless the system completely implodes, or they let it implode, or there's some sort of compromise of the grid. You know what I'm saying? But other than that, it's going to be a slow motion collapse. We're going to witness it day by day. We're going to watch it here and grab your popcorn and what you will, to just watch these events unfold. And hopefully you're well at this time. Hopefully you're not, someone in your 80s forced to work. Some people do just go to work though because they like it. They like the social outlet. They like, remaining active and thinking about things. They don't want to just sit around and watch TV and stare at the wall all day. But unfortunately, due to the economy, due to the cost of living, a lot of people are unretiring. So that's what I'm seeing. Please let me know what you think about all this. Are you seeing older people working in stores when they would rather be at the casino or something like that, or maybe out fishing? Who knows? Maybe traveling, maybe playing with their grandkids. Who knows? But please let me know what you think down in the comments too about this exploding credit card debt. What's it going to look like? Is it going to be a tsunami this year, this summer? What's your prediction? Also, are you holding any dividend paying stocks, even though there's a risk of big downside in the stock market? Or have you moved more towards cash or just a savings account, or maybe even precious metals as a defense play against what's happening? Please let me know down in the comments. I do a little bit of all. I don't have the magic bullet to say, let's go all in there, all in here, kind of spreading out my risk there in different areas in different ways. All right, so that's what I'm up to. Hope everybody's well. Have a good and happy Wednesday. We'll hopefully see you back here tomorrow. Big love. Keep stacking. Bye for now. And